So yet again today, the S&P is trading down by about 0.5%. And this is starting to look more and more like a correction. A lot of people take argument with this, but I think a lot of this downside we have seen in the S&P in the last couple of days has been due to the political landscape that we are currently in. Is Joe Biden going to step out of the race? Is he not going to? There's a lot of conflicting reports, including today it's being reported that Joe Biden's family is trying to get him to step down. And I know a lot of people have said, well, wouldn't this cause an easier victory for Trump, and Trump's policies are better for equities like lower corporate tax rates and the like? And my answer to that is no. Number one, if you get a healthy candidate to try to rival Trump, then Trump's odds will likely drop that he does win, potentially bad news for markets. But just purely from the uncertainty standpoint, who's gonna step up? Is it going to be Kamala Harris? Is it gonna be another 2016 Trump versus a Clinton again? I mean, what's gonna happen? And yes, I'm referring to Hillary, not Bill Clinton. So there's a lot of uncertainty there, and when there's uncertainty, that usually means downside, because if you get bad news, you can forecast for that. If you get uncertainty, you don't have a way to forecast for that. Not accurately, at least. We will go over exactly what big money is saying about our markets, this potential correction that is starting to form, and also what Tom Lee just said about the small cap summer. Fundstrat Tom Lee says summer of small caps is intact. The -4% correction mirrors the October through December 2023 5% correction. There was none after that, with sunny skies ahead. As we stated earlier this week, we believe this is the summer of small caps, with a sizable rally underway that will exceed the October to December 2023 gain for IWM, -0.3% of 27%. So considering in small caps, you have seen about an 11% rally from bottom to top so far, you could more than double that, is what Tom Lee is saying here. And I think this does make a lot of sense, right? Small caps, their growth on an EPS basis is going to far exceed the S&P 500 for at least the next 2 years. If we really do have a soft landing and rates go lower, these Russell stocks are trading at ultra low, almost historically low valuations, and you should likely see some appreciation in those stocks. As markets are a forward-looking instrument, they're looking ahead to the future, and I mean, as long as we have a soft landing and the economy continues to do okay, the future looks pretty good for small caps. Albeit, even if we do get a Trump presidency and we get more rate cuts, then that's gonna mean, well, even more good news for small caps. So that's another reason why small caps have been rallying in the first place. Now, I do want to really kick off this video with this clip from CNBC. It's about 5 minutes long, and it's from Joe Terranova that says, we're in the early stages of a needed market correction. This is an individual I highly respect. He runs a momentum portfolio, so follows momentum. So I think his insight's pretty valuable here.
That takes us to our talk of the tape. So is this just a midsummer squall to wash away some excesses, refresh the bull market, or is a more threatening change in the market weather underway? Here to weigh the evidence are Joe Terranova of Virtus Investment Partners, a CNBC contributor, as well as BMO strategist Brian Belsky and Alicia Levine, BNY Wealth Head of Investment Strategy. Welcome to you all. And Joe, you know, extended periods of calm markets, often followed by a little bit of action, a little bit of turbulence. We have that here. What's the message you read in what we've been dealing with?
Well, listen, you've done a great job all year talking about how Q3 could be a little bit bumpy. And it seems as though as we move into the earnings season, that's exactly what we're going to be getting right now. For the viewers, for investors out there, long-term investors, this is a tough environment right now because you have so many conflicting signals on a daily basis. It looks like we're getting this rotation within the market. Early this morning, it appeared as though that would continue. NASDAQ came under pressure. We had small caps lifting, but we've reversed that now intraday. And now for the first time, really in the last couple of weeks, you have a universal sell-off, a broad-based sell-off. You have small caps down. You have the NASDAQ down. You have the momentum factor down. A lot of the leaders that I've talked about on halftime, I own some of them. Goldman Sachs, JP Morgan, they're down significantly. Eli Lilly down as well. So
yeah, Chipotle's down like 5%
I think
again.
The picture that tells it all, if we could pull it up, is the VIX. Because you've got the VIX spiking up to 16. I know that doesn't sound high, but it's certainly a lot higher than it's been over the last 3 months. It's its highest level since April. We were above 21 in April, and we probably have the blossoming of a much-needed correction.
You know, Alicia, it's maybe just a little bit of a reminder to investors that a broader market, or one that's not kind of anchored by a handful of huge stocks, is not necessarily in the near term a more stable one or a more predictable one. But how do you think investors should be reacting to it, if at all?
So I see this as the healthy correction in a broader uptrend. I mean, as you said, we're coming into seasonal weakness. August and September sort of never failed to disappoint on the index level, and we're heading right into it after an epic climb the first half of the year. So that makes sense to us. What looked like rotation into small caps, it can continue, but ultimately, I think if you go forward structurally, the large caps are going to take over here simply because there's not enough market cap in the small caps to absorb the total rotation out of the large caps. If you just look at the top 10 stocks of the S&P, they're 5.5 times the market cap of the Russell, and the S&P itself is 15 times the market cap of the Russell. So it's a little bit like putting an elephant through a needle, which is what we saw. We saw 3 and 4% moves in a short period of time. That has to be digested. It's very healthy. An average year has a 12% drawdown on the index level for the S&P. We barely had 6% in April, and I think we're probably due for another 5% here.
You know, Brian, the big versus small equation and that bit of rotation, or at least just a little bit of a comeback from those extreme relative performance metrics, is only one way of viewing what's going on, right? It's also kind of a growth into value. It's the very top of the S&P into some of the rest, things like financials doing better here. So how do you read that, and what should we extrapolate, if anything, from the relative moves in the last week or so?
Well, thanks for having us, Mike. We would say that what's happening is very normal. We would say that this is part of a very broad and big picture normalization process, believe it or not. What's happening in the market, we said 8 months ago in print that the average correction during the second year of a bull market, which we've been talking about now for 2 years, within a 25-year secular bull market, which we've been talking about since 2009, is 9.4%. As Alicia said, we only had 5.5%. That's not enough. And obviously, on a near-term basis, we were overheated. Now, I do believe that it's very normal to get broader participation. We are entering a golden age of stock picking where you're going to need to own a lot of everything. Our theme for 2024 was everybody love everybody, meaning you got to own a little bit of everything, and now it's starting to come into fruition. So value was massively oversold on a technical basis, so a small mid-cap. But it's not about just technicals and price, Mike. This is about fundamentals. Now, starting with small mid-cap, we're talking about earnings discernment, cash flow, balance sheet, strength, the strongest in my 35-year career. You have a scarcity proposal in small mid-cap too, especially given the fact there's no banking deals and nobody's buying small mid-cap over the last few years. And then lastly on value, more of a GARPy value we think makes more sense, but we do think everybody's going to go up together once we go through this very normal correction, and it's happening right now.
And I actually think the last sentence of that clip was very important. BMO thinks when things go up after this correction, everything's going to go up. And I believe that too. Now, I think with this election volatility, I think it's getting pulled forward a little bit. So instead of perhaps getting that election volatility in October like you normally do, right before the election, I think you're getting that now, and I think you're going to get that throughout August and September. I don't know if we're going to get just, a straight line down and then a straight V-line recovery. I think it can take some time here, and then maybe even perhaps before the election, you start to get some of that rally again. I think when investors look at history and they try to game out, this history is going to repeat itself thing, I think the markets are smarter than that. And I think when everyone bets for that outcome, you're not likely to get that outcome. So that's why I think some of this election volatility is getting pulled forward, and maybe we actually rally in October. But most certainly we likely rally November and December as we normally do after the election. So right now, I actually think is a beautiful time to be repositioning your portfolio for that end of the year rally. Now, if you are a savvy investor or trader, I should say, and want to get some puts on this market, I think that still makes sense as you are still relatively near all-time highs heading into earnings season. I think there's going to be a fair bit of disappointments here and there across the board. I think your Super 6 is still pretty well priced for perfection. I think estimates are still very high, and I think there still can be more downside here. But if you are the long-only investor, I do think now is a good time to reposition. I think we kind of have a heads up of this small cap outperformance that we are likely going to see. And I think we're really going to see that by the end of this year. And maybe Tom Lee shouldn't just call this a small cap summer. I think he should call this a small cap couple of years. Because again, if we do go through a soft landing, the economy does fine, inflation falls, we get, let's say, a Trump presidency with more rate cuts associated with it, then I don't see how small caps underperform for the next year or two. Mike Zaccardi on X says equities tend to perform well after the Fed starts cutting unless growth is weak. And that's really the thing we want to be watching here is how is the economy doing? As long as the economy is good, I think this is a bull market, as I've said many times before. And we've been overdue for a correction. That's why I've been calling for a correction for the last couple of weeks. But if growth stays good and the Fed starts to cut, that's going to be really good for stocks. But if you start to get more of that R word being thrown around, which is recession, that's where things are going to get even worse for equities. But good news is I don't think we're there yet. Seth Golden writes, a fierce rally often portends a modest retracement, but to a lesser degree. 5-day rotation, such as expressed in small caps of this magnitude, has only triggered 3 other times in 75 years, every single time it persisted. So basically saying the small cap rally is likely going to continue. Game of Trade says beware, the probability of a recession by December 2024 is at 63%. This level has only been seen 3 times since 1960, and that was 1974, 1980, and 1981. All 3 ended in severe recessions. This is judged off of the yield curve. This is still the longest streak since the global financial crisis without a 2% drop for the S&P 500. The past few days have definitely added some more volatility, but not enough to end this streak just yet. And maybe the signal to buy the dip could be that streak ending if we do see a 2% drawdown on the S&P 500. U.S. Conference Board leading economic index is negative 14.2% off its previous peak. We are in recession territory. I think a lot of this comes down to inflation being as high as it has been and the Fed keeping rates as high as they have. Banjiri says on X, quote, we think a lot of this rally is being driven by near record exuberance in IWM call activity, eclipsing December 2023 levels. This is research according to UBS, where you can see the call activity in the Russell 2000 that is going absolutely bonkers. Chinese investors dump record amounts of U.S. securities. Surely this has nothing to do with the rising trade tensions between the U.S. and China. It is being reported today that Biden's family starts discussing his exit plan from the race. And this was another big headline that sparked a lot of this downside today. It would not be uncommon, according to Seth Golden, if after the rapid and fierce small cap rally to see the retracement of 1/3 of the advance. A fib retrace to the 38.2% level would be healthy and likely prove to be an opportunity, which is around about 213 for IWM. IWM is currently trading at 217, so that would represent a couple of dollars of additional downside. And I will say, small caps are outperforming the S&P today, with the S&P at the time of recording this video down 0.73% and IWM down 0.46%, which is a notable outperformance. Considering when you do go through market corrections, in which it looks like we are now, you usually see the Russell that underperforms, and that's not happening. Your latest AI investor sentiment survey shows bullish investors at 52.7%, neutral investors at 23.8%, and bearish investors at 23.4%. The percent of stocks trading above their 50-day moving average is down about 3.5% today to 64.47%. 2.3% of all stocks are falling under their 50-day moving average, which these are still much better levels than where you were even just a couple of weeks ago, when 35% of stocks were only trading above their 50-day moving average. Yet again today, what's notable is the VIX is now up to 16.94, up 6.34% today. So it looks like there's more firms or individuals that are going out and buying S&P puts. The VIX measures the puts and calls on the S&P 500. So if the VIX is going up, that means there's more puts being bought than calls. The Atlanta Fed GDP Now tracker is estimating 2.7% GDP for Q2, up from about 1.5% expected GDP to start July. 10-year Treasury yields are up about 5 basis points today, which is also putting some downside pressure on markets, up to a yield of 4.24%. Despite this, Fed funds futures contracts that are for December 18, 2024 are still pricing in 3 rate cuts by the end of this year, with 50.3% odds. 2 cuts are priced at 43.0% odds. And if you look at September, there is a 98% chance of seeing at least 1 cut by September 18. So virtually a 100% probability. And there is a 56.0% chance of 2 rate cuts by November. So markets are pricing in a cut September, November, and December, which again, as long as the economy stays strong, is good news for markets. We can see interesting and unusual option activity today for IWM, and big money is about 17% positive. So there's actually quite a bit of negative orders coming through for the Russell 2000 today. We can see the short position in the Russell continuing to be covered on, going from about 31% short interest now down to 23.23%. For the S&P 500, interesting flow sentiment over on Ortex is showing a positive order value of 44%. And same story here, the short interest continues to fall from where we were recently at 11.67% down to 9.47%. The interesting flow sentiment as well over on Ortex for the triple Qs, which represents the NASDAQ 100, that is down 1% today, shows a positive order value of 42%. And shorts continue to cover on short positions here, but to a lesser extreme degree because the overall short position was smaller, going from 8.67% now down to 7.37%. So it looks like even on these red days, shorts are taking the opportunity to cover on some of their short positions, especially in the Russell, which does show an overall bullish skew towards small caps still. Now, if we take a look at the S&P 500, specifically the SPY ETF, the big level that I'm really watching for next is 538. That would represent about $10 of downside from here. That is the 50-day moving average. That would put the top to bottom correction potentially at about 4.7%. That's the level I'm watching for first. This also does connect with the gap up that you've seen on June 10th and June 11th. The real level that I think markets will get to is about 525. That is this 100-day moving average. That would be a 7.3% correction. And if things got to be more like an average correction during an election year, that would put you down to this 200-day moving average at about 491 on the SPY. Now, I think that's a little bit less likely, but I still think it's possible. Now, if we get to these major moving averages, I would expect some short-term support around them at all three of them. And specifically, there's going to be a lot of people coming in and buying the dip around this 200-day moving average if we do get down to that level. Now, the RSI on the S&P is at 49.49, so now you're just back to neutral. If we see the RSI go back down to 30, in which you did see back on April 19th during this 6% drawdown or so on the S&P, I mean, you're probably going to need to see another 3-4% or so downside on the S&P to get to that 30 level. TLT today is down 0.5%, oil is down almost 2% today, and the dollar is up 0.1%. So let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel if you made it to the end of this video and or you learned something. Consider sticking around a while. We will help you be more educated, more informed, and make better decisions to help you make more money. Thank you for watching. Enjoy the rest of your day, and most importantly, enjoy it. I will see you in the next one.